So, yep, we are live. Testing, testing, 1, 2, 3. Testing, 1, 2, 3. Testing, 1, 2, 3. Can anybody hear me? Testing, 1, 2, 3. Yep, testing, 1, 2, 3. For those who join, can you guys hear me? All right. Okay. Yes. All right. Yes, you can hear me. Good evening, everyone. Good evening. Yes. So we are going to start at 8 o'clock. So yeah. Yes, here's the option hunter. Yeah. Hi, 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 hi. Hi everyone. Hi everyone. So we're going to start at 8 o'clock. So yeah. Good evening. Hi. Yeah. Nyonya Kue. Yeah. Good evening. Good evening. Hi Goldens. Hi. Chat. Yeah. Let's chat. Let's chat. So we have 4 minutes to go so that we'll wait the rest of them to join. So yeah. Today's session is going to be more like a clearing off those kind of confusions about the option trading. So hope you guys really can pay a lot of attention about the role of the in the options. Yeah. Yeah, there are a few very important things that need to note down. So before you guys are getting into this kind of the um, spread or maybe those kind of the single leg options, how you manage the expiration, those kind of things. So it's kind of important for this chapter. So hope you guys can pay more attention into this chapter. If you guys have any question, you guys can always type in, and then I try to address those questions as much as I can. So Option Hunter will be helping me to actually address those kind of questions that I didn't manage to address as well. So that feel free to actually ask, because sometimes like the chat box is too 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 fast, and then I sometimes I might miss some of the message. Okay. Just a little bit of the chit chat. Did you guys watch the chapter 1, navigating options with Moomoo? If you guys watch it, type 1. Okay, guys, type 1. If you guys did watch the chapter 1, let me know like if you guys have completed the chapter 1. Oh, hi, Tita for lunch. Yes, 1. Yes, yes, yes. So only 1. Only 1 complete the first chapter. Yeah, Option Hunter is starting his usual opening. Usually they will ask he love to ask you to introduce yourselves and then ask you where you guys come from. Yeah, you know, Keith. Hi Keith. So we are going to start at 8 o'clock for those who just joined the section. So yeah. Singapore. Oh, okay, Singapore. I'll be in Singapore tomorrow. Couldn't watch chapter 1. Couldn't watch chapter 1. You can watch the replay actually. You can watch the replay actually. So you can go to the option playbook pages. There will be a replay buttons for you to actually watch it. Perth. Okay. We're from someone from Perth, Penang. Oh, Mr. Chuck with you, man. Yeah. Like for those who can you guys see the chat from the text messages from the option hunter? If you guys have missed the chapter 1, please make sure that you click the links and then you can watch the replay. Trade person can't get in. Please, because of visa and I'm straight because can't get in. Yeah, sometimes that happens. That happens. Okay. So like we're for those who just joined the sections, and then we are going to start now. And then before we are starting the sections, so I'm just going to ask, like, is there how many of you actually complete the chapter one? If you have complete the chapter one, which is the one that I did for the last 2 weeks, please type one. Yes, I just want to make sure that see like how many of you like actually is like complete, so that it's much more, but still one, but still don't really understand. It's okay, it's okay, because like you basically the chapter one is just telling you like how you actually can understand better in option trading in those kind of components. At the first signs, actually you might feel confused because there's a lot of things to actually remember, right? Actually there's five things to remember. So but as our sessions going more and more and more, and you kind of like catch where we are coming from, and then we will be starting to connecting to the dot, like, okay. So yeah, I only received two people typing one. So yeah. So if let's say you guys actually haven't watched the chapter one, please make sure that you go visit the pages and then watch the replay, because the foundation is quite important. Because when you guys look at the option chain, those kind of things, like you might feel confused without the fundamentals of it. Oh yes, there's another one, right? Okay, so we are going. So it's 8 o'clock already. So we are going to start these sections. So first thing first, of course, we are going to talk about. Must have disclaimers lah. So everything's like we conduct and then we shares here is purely for education purpose only. So please don't take any words or any kind of a sentence, any things that I present as an financial advice. Okay, this is purely for education purpose only. So make sure you keep that in mind. Okay. So like this in today's chapter, we are going to cover, I would say, for beginner, it will be the most important chapter that you guys need to understand. It's the two sides of the trades, the buyer and the seller. Okay. So in this title, I'll just make it like looks very, very fancy. Fighting a clock versus the rent. Okay. Basically, it's just like interpreting the buyer and the seller. And then we are going to touch more on like who's in control, and then what is the buyer roles and what is the seller roles. Okay. So you guys have been trading stock or investing in stocks, right? I believe that a lot of you only just applying the long only strategies, right? Okay, let me know if you are just long only strategy. Type two if you are long only strategies. Okay, if you are trading or investing, you just long. Okay, and then type two if you just only long. Type three if you try long and shorts. Yeah. So let me see like how many of you actually is like just long, and how many of you had tried to. Okay, we actually have long shots. Yeah, long shots. Yes, long shots. Long shots. Yes, yes. Long shots. Okay. So yes, 2.5. What is 2.5? Okay. Yeah, memang Doctor Strangers. Okay, two. So I see the majority of you actually is like long only, and then yes, there's some of you have short. Okay, it will be much more easier for you to understand if you have short the underlyings before, like be it ETF or any kind of the stock. So in option is also the same. We actually have buyer. There will be the seller as well. So a lot of people have this kind of a misconceptions, like option you can only buy the option. So that's kind of wrong, because like in some way, like some if let's say you have the margin account, basically you can actually do long and also do shorts on the options. Okay, so let's do some recap. Okay, for this chapter one, we actually have covered 5 things. It's kind of heavy, right? Because like last chapter, we already covered this. You must understand what underlines that you are trading, right? So like some underlines can be like commodities, stocks, ETF, and those kind of the futures, the derivative of the derivative. We have covered all this, and then so that before you start trading, so you must actually know what underlines you are trading. The second ones will be the directions. Okay, like are you betting the underlines will be going up, or are you betting the underlines is going down? So it will be dictates which kind of the options that you are going to choose, either whether it's a call or whether it's a put options. So the third thing is, once you have buy the options, you also knows that buying an option is actually having the rights. It's actually having the rights to actually for you to buy or sell the underlying at a certain price, right? Okay. The fourth one is the expiration. We know that because the option is a derivative, so that it won't be there forever. There will be a time limit for the option exists in the market. So there will be expirations. Okay. So if we want to buy the option, it's not free, right? It's not definitely not free. You need to pay, right? Okay. How much does it cost me? But for the chapter one, I've made it so easy because like um you guys actually is much more focusing on the we only cover the long side, like buying an option. It's much more easy. So it much more easy to understand like those kind of components that we have covered. Okay. So in today's sections, we are going to discover who are you buying it from, because like in chapter one, we actually covered buyers, right? So if you want to buy something, there must be someone who actually willing to sell it to you, right? That's why we have a bid ask in the market. So what is the best offer for buying it? What is the best offer for selling it? So in chapter one, we covered the buyers because we basically you pay a premium and then you own the vouchers. Basically, you means that you have the rights to uh benefit it. And then if let's say if out of the many, then you can just walk away. In today's sessions, I'm going to introduce you the seller. Okay, the seller. You guys might have heard a lot of those kind of things like the seller collect the premium, those kind of things, right? So in today's sections, we are going to uncover the role of seller. Okay. So remember this, every trade has two sides. Okay, there will be a buyer and there will be a seller. For buyer, remember when you buy the options, you're having the rights. And for now, I want you guys to remember, for seller, you are having obligations. Okay, you are having obligation. Okay, what it means by that? Okay, so let's get into the first part, rights and obligations. So remember that we mentioned that there will be two types of the options, right? One is the call options, and another one is the put options. Okay, remember we covered that the bias is basically you buy the options for having the rights to control the assets, right? But the rights, the different options that you bought is having a different rights. For call options, if you guys forgot, if the buyer buy the call option, you're basically having the rights to buy the underlyings. To buy the underlying. Say for example, if your strike price is $100, even though the price underlying prices goes up to $120, you still have the rights to buy at $100. Okay, so let's skip for the seller for now. Let's look at the put options. For put option, if a buyer buy and put options, so basically you are having the rights to actually sell the underlying. So say for example, if let's say your strike price is $100, when the market falls down to $80, you're still having the rights to actually sell the underlying at $100. Okay, sell at $100 even though the market is went down. So because like you having the buyers, right, you are buying the underlyings, right? Basically, who are you buying it from? You might wonder. Okay, it cannot be came from nowhere. I came from the thin airs, right? So remember, I mentioned like when every trade has a two side. So if let's say the buyer having the rights to actually buy the underlying, when they choose to exercise the options, someone has to obligate to sell to them. Someone obligated to sell to them. Okay, and then that is the seller part. So remember, in call options, seller has the obligation to sell the underlying. Because when buyer is exercising their rights to buy the underlyings, the seller is, is the one who responsible to sell the underlying to the buyer, no matter what price you own it from. Okay, no matter what price the seller own it from, the die have to sell the underlying to the buyer at the strike price. Okay, it's obligated. They cannot act like a buyers like I don't want to exercise, I can just walk away. Whenever the buyer exercise, the seller must fulfill the obligations, okay, to sell the underlyings. So remember that call options, when buyer having the rights to buy the call options, you're having the rights to buy the underlying. If the seller if the seller sell the call options, they have the obligation to sell the underlying. Remember that, huh? Remember that, because in the futures we are going to cover a lot of those kind of spread things. Okay, you guys must remember what's the obligation for the seller on the call option. Okay, so let's look at the put option. This is where people get a lot of confusion because like it's like always like upside down, right? You always turn the upside down. Okay, let's see the option hunter will be help me to address the questions. First, I'll be carry on so that the whole sections can be much more smoother now. So put options basically give the buyer having the rights to sell the underlyings, right? I mentioned like if let's say strike price is $100, when the market falls to $80, you still can sell at $100, right? So when you want to sell the underlying, there must be someone to actually obligated to buy from you, right? Okay. So on the flip side, the seller of the put option, okay, seller of the put option actually has the obligation to buy the underlying. Okay, remember this. The seller of the put option has the obligation to buy the underlyings from the buyers of the put options. Okay, it just a flip side from the call options. Okay, I want you guys remember this. Everyone okay about these sections? Remember this. When you are a seller of the put option, your obligation is to buy the underlying from the buyers. When you are the seller of the call options, you are having the obligation to sell the underlyings to the buyers. Okay, very simple, right? Okay, so if everyone is okay, clear, then can you give me a 1 about these sections? Because it's very important. I want you guys actually to remember this. So buyer having the rights to buy for the call options, seller to sell the underlyings. If let's say they sell the call option. Okay. Okay. All right. So very clear. Okay. So once we have this clear out, then we move on to have some recaps. Okay. So in the options, right, we always talk about the 4 leg things. The 4 legs thing. What is the 4 legs like? 4 legs is basically means like you can buy the option, you can sell the options for the call for on the call options, which means that there will be 2. You can have one leg, one direction, another one direction, and then you can also buy put, also sell put. So there will be 4 options for you actually to choose. Okay, there will be 4 options for you to choose whether you want to be a buyer, or you want to be a seller. So let's take a look at these kind of examples. Okay, for this example, I think if you guys have watched the chapter 1, I think you guys have been familiar with it. Basically, you just pay $10 and then to buy the voucher to lock at $150 for this concert ticket. So the seller actually, you just like it's just like, okay, it's yours, and then you just pay me the $10. Okay. So basically the buyer get all those kind of upside without paying the full price, because if let's say he want to pay the full price of the concert, he is going to pay $150, right? But at the end of the day, there will be two scenarios. If let's say the tickets is like spec up, is very demanding. Eventually it spec up until $400. So the seller, the buyer can exercise their rights to buy the tickets from the seller, and then at what prices? At the strike price. Okay. So basically, if let's say someone want to actually like buy the ticket, this fellow can actually sell the ticket for $400, so that he make the profit difference. Okay. If let's say the concert actually just is very dull, and then nobody wants to visit the concert, and then the buyer, the max loss for the buyer is just like lose $10, right? Okay. It just like lose $10. Okay. This is where it gets interesting. The $10 he paid to the seller, right? He paid to the seller. So the seller gets to keep the premium, get to keep the premium that the buyer initially paid. Okay, in this case. Okay, even though like the buyer of the even though the buyer exercised the the options to buy the ticket at 150, the $10 also cannot be refunded. No matter how the seller collects the premium at the end of the day. Okay, so let's look at these examples, like sell, or we call it short call options. Okay, the sellers like says like, you pay me $10 now, I promise to sell you the ticket at $150. Very similar, right? It's the same story actually. You just so the buyer will be pay the booking fees, the premium, to actually lock the price at $150. So me as a seller just lock the price at $150 for you. So if let's say the price stays low, nobody's going to buy it. So you just basically keep the $10. Okay. For example, the concert cancels already. So the buyer cancels already. The buyer won't exercise the right to actually buy ticket at $150, right? Because the cancel already, why you want to go, right? So basically, he just keep the $10 pure profit. Okay, but if if the buyer of the call options decided to actually exercise, then if let's say this fellow doesn't have the ticket on his in his pocket, he just have to buy the ticket at $400 from anywhere, from any third party, just to sell the buyers at $150, because he promised to sell the ticket to the buyer at $150. If he doesn't have the ticket, he just have to buy from the market at $400 and then sell to the buyer at $150. So basically, the seller in this case, he lose money, right? Okay, he lose money. Okay, so let's look at the long put options. Okay, so put option basically is like insurance. Okay, basically it's just saying that I want to insure my car. Okay, this car can be interpreted as the underlines. So if let's say I just want to pay the buyer of the put pay the $500 to actually buy the insurance. Basically, it's a put options to look at the 50,000. So the seller of the put options, like saying that, okay, you are covered. So how this one actually is about. So did he secure 50,000 protection for just $500 for this buyer? Okay. So if let's say the car actually went into an accident, basically the insurance will be promised to actually buy the car from him actually to at 50K. This is the strike price. So if let's say no crash, the buyer just lost $500 the premium fees. Okay. So on the flip side is the short put options. Okay, basically is like the same story. The buyer of the puts pay the seller to says that, oh, actually I'll just the seller, sorry, it's not to be just seller. the seller should be taking the premium for $500. So basically, what he are betting the car won't be happen any accidents, right? It's just like insurance. Like you're paying the insurance already, and then those insurance companies are expecting you won't be having any accidents, so that they can keep your premiums. Like if let's say nothing happens, correct or not? So the seller of the put options thinks that as long as he drives safely, this 500 premium you just keep it in the pocket. So no accidents, then the $500 is yours. Okay, after expiration, expire already, then you are not under coverage already, ma. The $500 is in your pocket. So if let's say it crashed already, then the insurance company have to pay, right? Have to say like, okay, I can you got cover for how much? For 50,000. So I have to like pay for 50,000 to buy this car, or maybe pay him the cash in the reality. Okay, so that's basically is like how the short and long option works. Okay, so we we have enough of those kind of a story. So basically, I just want you guys like understands like how is the buyer and the seller role. It's very similar to what we are actually facing in the in our lifetime, because like insurance, like we are buying a movie ticket, all those kind of things. It's very similar actually. Okay, so we are so let's getting into those the technical parts, which is the settlement roadmap. Okay, in today's sections, we are going to cover two parts. One is the settlement roadmap. Another one is the trading path. We are going to clear out the confuse from the settlement path first. Okay, so I want you guys to actually pay attention to this part. When you actually are a buyer, you are having the rights, right? Okay, you are having the rights. So what you do in the step one? Usually you will pay a premium to enter into the trades. Okay, you pay the premium to enter into a trade. Remember the chapter I mentioned, options doesn't come free. Okay, you have to buy it. So you pay the premium to enter the trade. You already have the rights. Okay, it can be a call option or put option. Okay, it can be either one of the options. But just remember that if you're a buyer, you pay the premiums to enter the trade. You're having the rights. In this kind of a step, okay, in this step, we call it buy to open. We call it buy to open. Remember that, okay? In the short form, we call it BTO, buy to open. Remember this because I'm going to mention a lot of these words in the later parts. So, indeed, if you are paying a premium to enter the trade, which means that you are buying a call or buying a put, you are basically buy to open. Okay, so you buy to open to buy this, pay a premium to enter into this contract. The expiration you choose is like 30 days to expirations. Okay, so so the next step is that what you can do. Okay, what you can do. The first options is that once you buy the option, you actually can exit. Okay, you actually can exit. Basically, in this case, we call it sell to close because you buy to open, and then you want to sell it to other people's. Okay, you want to sell it to other buyers. So you must find some seller to actually buy from you, right? So we call it sell to close. Okay, basically you just sell to exit early before the expiration. Before the expiration. Remember, before the expiration, you actually can buy to open and sell to close before the expiration. Because while during the times when you buy the options, right, the premium will be fluctuate, so that you actually can make the difference, the price difference from these actions. But because in these sessions we are going to cover the exercise part, so I want you guys to actually focus on here. If you do not things and you hold until the end of the expiration, you let the option expire. Okay, you don't close the position. You just let the option expire. And you do nothing. You just hold it. Okay. So what will happen? Okay. So if let's say sorry, I want to cover this one first. You have three outcomes actually. Like the first one, like I remember last for the chapter one got someone to ask me the early exercise. What do you mean by early exercise? Says for example, like if let's say that your strike price is $100, the underlying price is $120, but you haven't reached the expiration. You haven't reached the expiration. So what you actually can do, remember you're having the rights to actually do what? To buy or sell the underlyings, right? Anytime before the expiration, if you are American option, okay? This is only applicable to American options, I remember, guys. You can actually, for example, like you enter into a 30 days days to expiration. After 15 days, there are 15 days to expiration left. You can, if let's say it's in the money, you can actually choose to early exercise your option to buy the underlyings. Okay, and this is optional. You can choose whether you want to do it earlier or not. Early exercise. Okay, but if you don't do early exercise, you can also choose, if you want to exceed the position, you can also sell to close. But okay, now clear, we have this clear before the expiration. But if let's say you do nothing, there will be two outcomes. Okay, one, if the call option that you bought, is expired in the money. Says for example, underlying is $120, your strike price is $100. So your option is in the money. And then you do nothing. You hold it until expiration. Usually it will trigger a thing called auto exercise. Okay? It will trigger a thing called auto exercise. Basically means what? You will be auto exercising the rights to buy the underlying at the strike price. So be mindful of that. If you guys have the buying power in your account and then you don't manage your position and you do nothing and it's in the money, usually the system will be triggered to auto exercise and then you are buying, basically you are buying the underlyings at the strike price. Okay, it will auto exercise. So if you don't want the underlying, make sure you close your position before it happens. Okay, before it happens. But some people might asking, if let's say my account doesn't have that much of a money to buy the underlying at that prices for 100 shares. Usually, in the common practice, at the expiration days, before the market close, before the 3 hours before the market close, usually those dealer will be check your position size. You'll be checking your buying power. If you doesn't have enough buying power to fulfill the exercise to buy the 100 shares, the dealer actually have the rights to actually close your option position. Okay, that because you doesn't have the money to actually buy the underlyings, right? They actually have the rights to actually close your position before the market closes, or waive your rights. Okay, remember that at the expirations. So if let's say it's out of the money, what will happen? Because it's out of the money, so basically the option will be just expire worthless. Okay? I want you guys to understand this well. So some people's like asking like if they have a lot of buying power, they actually have the money to actually buy the options. Out of a sudden, they didn't manage the position, and then the option is in the money. They actually don't want to hold the underlyings one. They don't want to acquire the underlying. They just want to make the price difference. But they didn't manage. It triggered the auto exercise. Out of a sudden, their portfolio got 100 shares of the underlyings. So make sure you be aware of that. Okay. So from the seller side, when the buyer to pay the premium to enter the trades, right? So that there will be a seller, right? there will be a seller. So the seller, when the times they click to sell to open, okay, in this case, they call it sell to open the position. Okay, sell to open the position. The moment they sell to open the position, they collect the premium to enter the trade. Okay, I repeat again, when the seller click the option, they press sell, and then to open the option position, they collect the premium to enter the trade. Okay, whereas the buyer is actually paying the premium. So this premium actually is paying to the seller. And then when their order got filled, they collect the premium from the buyer immediately. Okay, it's just like shorting. It's just like shorting. Okay, so in this step, we call it sell to open. We call it sell to open. So what happened next? You have two choices while you're holding the options. Okay, you have two choices. One, you before the expiration, you can actually buy to close. You can actually buy to close. Okay, when you sell to open, you can actually, if you want to close your position, you just want to exit. You don't want this position anymore. You can actually buy to close. Okay. Remember, when you open the position, you must close it. Okay. Just remember this way. So in this, but in seller obligation standpoint, right? It's kind of different from the buyer. Why? Because like when the buyer, if the buyer, assume that the buyer early exercise the options before the expiration, the seller, even though the options still have some days of the some time buffer, he still need to force to fulfill the obligation. It says, for example, if the buyer of the call options like is in the money and then they want to early exercise the option, the seller, no matter how, also have to sell the underlying to the buyer, even though before the expiration. This is why we say seller have the obligation to actually to fulfill the buyer rights. Okay, this is what we call like the assignment risk, because you don't know, you have no idea when is the buyer going to early exercise. It can happen anytime. For the buyer side, I can choose to exercise any time before the expirations. But for the seller perspective, because you don't know buyer when will early exercise, there will be an assignment risk. Okay, there will be an assignment risk. So that within this period, you have no choice. If let's say your option is in the money, there will be a chances that the buyer will be exercise the option and then you have to fulfill the obligation. So if let's say that you are in the money and then you don't want to actually, you think that the trade doesn't goes well, then you can close your position early. But if you do nothing, okay, there will be two scenarios. Okay, there will be two scenarios. One is if your option, the option that you sold is in the money and you do nothing, it will be the same. It will auto assign. Say, for example, if let's say in this case, if let's say this fellow also like hold it and then it's in the money, they are having the rights to buy, then you auto assign, you just sell your underlying. But if let's say you doesn't have the underlying, in your portfolio to sell it to the buyer, you will be entering into a short position at the strike price. Okay, you will be entering into the short position at the strike price. Okay, but if you doesn't have the buying power to maintain the short position, it's the same. The dealer usually will check 3 hours before the market close whether you have the buying power to maintain this short position or not. If let's say no, If the answer is no, then they will liquidate, which means it's close your option position, or with basically just close your option position. Yeah. But if let the option expired out of the money, okay, if the option expire out of the money, basically what the buyer will be lose the whole premium. Then initially you collect the premium already, what? So this one expire worthless. The buyer don't want to exercise the right because it's no point for him to actually exercise. So you get to keep all the premium. Oh, okay. So you get to keep all the premium. All right. So let's look at the examples, like buyer perspective. So if let's say a long call, okay, I'm long a call, and then the call maybe is like $3, and then 100 strike, $100 strike. If it's in the money, okay, if it's in the money, then the stock price like is at $120, and then the cash required for me to actually exercise the call option is like how much? Like $100 multiply 100, then it's like 10K, right? I have to actually pay 10K. But because I also buy the options for the rights, right? So I also have the cost of premium. So my net cost basis will be 10,300. But the market price is selling at what prices? 120, right? So my unrealized profit during that time, it will be around 1,700. Okay. Okay. Very, very clear, because like the market is trading at $120, and then you exercise your rights to buy the underlyings at $100. So you will be floating profit at 1,700. Around actually it will be 2,000, but actually because you paid 3,000 before, so for netting it, you just basically profit things like 1,700. But if let's say if out of the money, the stock price at 195. So your strike is $100, right? The underlyings during the time is like $95. So buyer won't be exercising, right? Because you can buy at from the market at $95. Why you want to buy at $100? So that basically this one will not exercise. You just lose the premium in this case. So let's look at the seller perspective obligation. So this one is a bit interesting. So if let's say that for the short call, examples, if you are shorting a call, same strike price, when you are shorting it, for example, you may be shorting it at $5. So $5 multiply $100 per contract, you are receive 500 premium. Okay. So when you actually if let's say the stock is trading at $120 and you are shorting at $100, you are losing money, right? Because you need to buy at $120 to actually close the position. Because you're shorting at $100, now it's $120, you basically is losing money. So maybe around like the buying power that need you to actually maintain the position, maybe like 10K. Then you have your premium, so your cash inflow is 10,500 because of the current stock price is trading at $120, while your shorting price at $100, you are losing 2,000. But because you have the premium at the beginning, so that you have to like minus out add in the profit of the profit, so that your whole P&L will be losing 1,500. Okay, your whole P&L will be losing 1,500. Okay. So if let's say you are shorting the call, then the stock price is trading at $95. The buyer will exercise, right, which means it's out of the money, right? After expiration, you just keep the 100% of the premium, which is $500, just like that. Just like that. Okay. So let's move on. Let's look at the put side. Okay, let's look at, just now we covered the call side, right? We cover up the call side. Now we look at the put side. If I long a put, if it's in the money and the stock is trading at $80, I can sell at $100 while it's trading at $90, which means that I can just proceed and then minus the premium paid. Basically, I will be having $1,008. Okay, it's just the same, just the same as the call option. But the difference is just like you can sell, you can short at $100 while the price is trading at $80, and then you have to minus out your premium paid. If the stock price is trading above the strike price, which means that for your put option is considered out of the money, the buyer won't exercise, and then the maximum loss is just like $200. It will be just so. This is from buyer perspective. If let's say you are shorting a put, okay. If it's in the money, the stock will be trading at $80. Okay, same right, because like it's for put option. If let's say it's $80 for this put option, will be considered in the money. So you are forcing to actually buy the stock at $100. Remember, the sell put is the obligation is what? Is to buy, right? Shorting the put, the obligation is to buy, right? So that when your option is $100 strike price, basically you are obligated to buy at $100 for 100 shares, but now it's trading at $80. So basically you are actually losing money. But because you sold the options at the beginnings, so you collected the premium. So in overall, you are actually like losing around like 1,006. You're losing around 1,006. Okay, but what if it's out of the money for put? Okay, if out of the money, then the buyer of the put won't be exercised, so you just get to keep the $400. Okay. Okay. So understand? Like, are we clear? It's kind of a lot, but I need you guys to actually understand how it works. Okay. I want you guys to actually understand how it works. Just remember that the directions, if you're a long call, you're expecting the price to go up. But if you are shorting the call, you are expecting what? You are expecting the price won't go above $100. Won't go above $100. So that you think, why I want to do a short call while I can do a long call, right? You think if let's say the price lands at $99, it lands at $98, $97, or maybe like $50, or maybe like 60, 70, be it, as long as the numbers that at the expiration they close is below 100 strike, you get to keep the premium. While if you're long a call, you can have only the price must be rise above what? Must be rise above 103. You only can profit. You can only go up one direction. While this one you can be sideways, you can be go down, you can rise a little bit, but as long as it stay below $100, you get to keep the whole premium. So in terms of the probability of profit, the seller having more advantage. Not to mention like the option will be decay. So yeah, usually it will be in option there usually it will be favor seller more. Okay, but if let's say you have a strong convictions of the directional, of course, this one the long one will be much more favorable. Okay, are we clear? Okay, it's kind of a lot, but I want you guys to actually understand this really well, because like it's a lot of people doesn't get the idea of like exercise and assignment. But remember, this one, because it's after expiration already, these calculations is assumed, all of these in the money calculation is assumed that you bought or short the stock, and you at the strike price already. You are holding the underlying. Okay, you're shorting at $100 while it's $120, then you of course you lose money, but because you initially you because it's a short options, then you collect the premium. Okay. For the short put one is much more easier to understand. You just shorting the put, you are actually buying the stock. But you are buying at $100 while market price is trading at $80. So you're actually losing money. But you're losing lesser because like you collected the premium. Okay. So are we good? So if we are clear, then we need to have a knowledge check. Of course, the knowledge checks, I want you guys to actually engage with it. The first 5 correct answer will get the 800 Moomoo points. Okay. So I'm going to count from 5 to 1, and then I'll be moving to the next slide so you guys answer it. So the first 5 will be getting the 800 Moomoo points, and then it will be delivered within 21 days. Okay, it won't be immediately because the back end have to check it. So are you guys ready? If you guys ready, I'll just type 1. Just get type 1 in the chat box. Okay, are you guys ready? All right. You guys are focused. Okay, let's move on to next slide. Okay, come on. Exercise. You have to answer 2 questions to actually get the points. Not so simple like last time already, right? Okay. So the exercise 1 is like, if you are a seller of the put option, what is your position regarding the underlying stock? Okay. And then the second question is like, a trader's buy to open the call option. What does this contract give them? Okay, you must type 2 answers. Come on. Okay, I'm seeing a lot of coming. Okay. Okay, let's look at so the answer is C for the first one. I'm obligated to buy the stock at the strike price because remember, the seller always have what? Have the obligation, never have the right. Only when you are buying the option, having the right. So the first answer is obligation. Then what is the opposite of the buyer? Buyer is having the rights to actually sell, right? So the opposite of the role will be buy. So I'm obligated to buy the stock at the strike price. So the second one is like traders want to buy to open the call options. Basically, it gives them what? The rights, because it's buy right. They're having the rights, and it's a call option, so they're having the rights to buy a stock at a specific prices. Okay, all right. Congratulations for those who answer correctly. For the first 5 fastest, the fastest one, top 5 will be deliver 800 Moomoo points to them within 21 days. Okay, congratulations. So let's move on. So now this is the most interesting part that you guys have been waiting for, the trading part. Okay, just now I mentioned a lot of things, right? The exercise, obligation, those kind of things, right? But in reality, a lot of the option tradings they will just go into the option market and then just buy to open and sell to close, or maybe they sell to open and sell buy to close. Okay, they just want to make the price difference only, because a lot of people, they don't want to actually fulfill those kind of the obligations one. Okay, so the first one is so for the second part is the trading path. Okay, remember what I mentioned, most people don't want to wait for the assignment, or maybe they don't want to exercise, because like if you're buying the underlying, it can be very expensive. Seriously, for majority. Okay, I'm not saying all of them, but majority of the retail trader, actually, they are, because of their account size, they don't actually like want to exercise the underlyings unless they really want to keep the stock, and then they have the money for it. Okay. So in this case, what they do in the option market, okay, if they will just go into the markets, and then for example, like the buyer, they will just buy the options, buy to open. And then since, for example, the call options, if let's say the call option goes up, the premium fluctuate, underlying price goes up, volatility price goes up, your premium will be going up, then they will just sell to close. End of the trade cycle. They buy to open, then they sell to close. So it won't be like they won't be doing those kind of the exercise, early exercise, auto exercise. Before expiration, they basically just buy to open, sell to close. That's all. And then some of them is like just want to benefit from the time decay of the options. They will just sell the options. They will sell to open the options, and then they will just buy to close. Okay, they will be just sell to open and buy to close. As from a seller perspective. So they don't want to actually getting into those kind of the situation where assignment or maybe auto assignment liquidation because you don't have the buying power. So they will just buy to close. But if let's say the buyer want to exercise early for a seller, then it's very bad luck lah. If let's say you were planning to actually buy to close, then the buyer actually early exercise, then no choice, you cannot buy to close before that. That's what we covered, right? The assignment risk. And then what is the direction? Just remember, if you are buyers of the option, buy low, sell high from a premium perspective. If you are seller, sell high, buy low. That's how you want to profit from two different kind of the role. Okay. Just a bit of the quick recap. Remember, when we want to enter into the options, we look at the premiums, right? Remember, each contract is represent 100 shares. We look at premiums. The premium $5 multiplied. Premiums is, let's say it's $5. $5 multiplied 100 shares, then it will be 500 cost. So if let's say I sell the options, it will be like collecting $500. If let's say I buy the options, I'll be paying $500. Okay, remember this one. Remember the intrinsic and extrinsic value from the chapter 1. Okay, if let's say your strike price is $100, the underlying price is trading at $120, you are in the money. But how much intrinsic value you have is the $20. So basically the underlying price minus your strike price. But for the put option, if let's say your underlying is trading at $90, so your put option is in the money situations. So how much intrinsic value you have? $10. Okay, $10. Basically the strike price minus your underlying prices. It's just on the flip side. Okay, you have a $10 intrinsic value. Okay, but I want you guys to actually like remember this extrinsic value things because whenever you are at the money or out of the money at the money for put option, okay, basically you've got no intrinsic value. All of your value it will be just extrinsic value. Okay, all of your value will be just extrinsic value. Okay, and then extrinsic value is what? Remember, like the lesser time you have, the lesser premium because it will depreciate. Remember the probability story I told you guys? The 4 days, 2 days, do things like 100 goes to 100 and $100 want to go to $120, 2 days higher probability or 4 days higher probability. Remember the story? Of course, the 4 days having the higher probability because they have the more time to travel to their above their strike price, right? So this explains like why the lesser the time it is, the lesser premium it will be because of the time decay and the probability perspective. Okay, and another thing is the volatility. Also because of the probability things. Okay, but because of I got mentions like extrinsic value is the volatility and the time value, right? So which is saying that extrinsic value can depreciate, but intrinsic value, no, it doesn't. Okay, it doesn't decay. I remember that. Okay. So this is the exercise we did from the chapter 1. I put it here so that you guys can recap. If let's say in the money, how much in the money, and in the money of the values, and how much is the premium consists. Like for example, like if it's in the money, $100 to $100 strike price for the put, and now it's trading at $80. I'm in the money. So in the money, how much? $20. So I have intrinsic value of $20. So the remaining one is what? $2 of extrinsic value. Okay, remember the chapter one. If let's say you didn't haven't go through it, then you remember to go to watch the chapter one. Okay, so now remember these things. Okay, for call options, in the general terms, okay, in the general terms, when the stock goes up, or maybe the underlying goes up, okay, your call option premium will be going up. Usually, okay, usually will be going up. But if let's say your stock goes down, your call option premium will be going down as well. Okay, will be going down as well. If let's say so let's look at our put option. If let's say for put options, right, when the stock goes up, okay, when the stock goes up, your premium will be going down. Your put option premium will be going down. But if let's say the stock goes down, okay, then your premium of the put options will be going up. Okay, will be going up. Remember this, remember this. Because what I want to cover is that we always want to, if you are buyer, buy low, sell high. If you are seller, sell high, buy low. And then you are now focusing on the directions, the premium changes. And then how it changes depends on which option you are trading it. Okay? So this is one of the extra things I gave you guys, okay? So usually, if you guys realize, okay, if you guys look at the option change, right, you will realize that the extrinsic value are usually peak at the money. Usually peak at the money because the at the money at strike price have a 50-50 chances to go in the money or out of the money. So the extrinsic prices usually peak at here. But as it goes deeper in the money, you will realize that the extrinsic value getting lesser and lesser. And your intrinsic value getting higher and higher because you can access. Because remember the extrinsic, how you calculate? Because like the deeper the money goes, the lower the price you can buy at the underlying for the call, right? Remember that? You can buy, if let's say it's trading at $120, then if the stock price is $100, then your strike price is 90, then it's a $10 intrinsic value. So if let's say it's getting higher and higher to $200, you still can buy at $90. The higher the intrinsic value it goes, but the extrinsic value will getting lower because the certainty. Okay, because it's the component already consists by intrinsic value. Okay. This is just one of the extra things I want you guys to actually understand, because like when you look at these kind of the things, right, you tend to also think which kind of the strike price I want to choose. Okay, which kind of a strike price I want to choose. Okay, think about it. So for the execution part, remember that if let's say you are buyer position a path, if you are bullish, you simply just buy to open call option and then you just sell to close after. Okay. For bearish outlook, you just buy to open the put options and then you sell to close. From a buyer perspective. Okay. But if you are seller position path, and then you are bullish or you are neutral, you are expecting sideways, it won't go above or below your strike price. Then you are sell to open the put and then you buy to close. Okay, sell to open, buy to close the put option if you are bullish and neutral. But if you are bearish and neutral, then you sell to open the call option and then you buy to close if you already have a profit. Okay, so how can you actually do that? Okay, if you guys want to buy an option, basically you just open up your option chain. You just click one of the strike price that you want to. Sorry, excuse me. want to buy, for example, it's like I want to buy a 485 of DGLD, and then this pricing at around like $5.30 in the mid price. So if I click on this, and then I make sure that I'm in the buy position, and then I'll just click trade. So after I confirm everything, it will lead me into the order dialog, so that once I getting into these pages, I can see how much, based on my buying power, how much actually I can use the cash to actually buy. How much I can use, how many contracts I can buy by using only cash, and how many I can use only margin. So if I've checked everything, then I'll just click buy, and then I'll just wait the position get filled. But if let's say this is called buy to open procedure, but if let's say I want to close this position, I want to close my but long position, okay, then it will be just sell to close. So once you already have a positions, right, it will appear in your portfolios. So you'll be having something like GLD call, and then it's trading at what price. You can tap on one of the numbers here, and then you will see there's a button here like trade. And then in this case, because you want to sell to close, right, they will be showing you like, because how many contracts I have? I bought one contract, right? And then if I want to close this position, I'll be just click trade, and then how many quantity maximum to sell? 1. Then I'll just click sell. So this is sell to close. Okay. Remember this. Don't click the wrong button. You want to buy to open, then sell to close. Remember this. Okay. Some people they treat it like a stock. Then it's still they still press they still press sell if let's say they already have a short position. But what if you want to short, like for example, like you want to short an option, for example, you want to short open $6. So which means that I'm expecting the price will go above $6. Okay. So I sell. So I click on the options, and then I make sure that I tap on the sell. I click on trade. So they will be showing me what's the maximum quantity I can sell short. So if let's say I want one contract, I'll just sell. Okay. Once I have sell the contracts already, it will appear -1. It will appear -1. So if I say I want to close this position, I already have a profit. Then I'll be just do what? I just click trade. In this case, I will check how many short position I have. 1. So if I want to close my position, I do what? I sell to open at the beginning, then I buy to close. Okay. Don't simply like because of behave like a stock because I already got a position, then I sell my position. It's not like that. If you are shorting something, you have to buy back to actually close the position. But remember that for those who actually have no experience on shorting shorting any kind of the instrument or products, basically this is how it works. You're shorting something to open, and then you want to buy back to close it. And then these are the procedure. Okay, so how does it work? Okay, so some people might asking like, Alvin, you talk so many already. Actually, we just want to know like how it works. Okay, so basically, if let's say for the profit path, if I long a call, I'm bullish or bearish. If I long a call, I'm bullish or bearish. Okay, assume that the strike price is $100. Let's say during the times I'm looking at the strike price $100. Then the premium is like $2. And then if I long a call, I'm bullish or bearish? Bullish, yes. Thank you. I'm bullish or expecting the price to go up. So if let's say the underlying price goes up, like for example, like from $100 it went up to $115. The premium price increase, right? The premium price increase because there's a loss of the intrinsic value in the components already. Then the extrinsic value will be getting lesser and lesser. Still have slight extrinsic value. Assume that there's still some time expiration. So the price from $2 went up to $15.50. But can you close the position? Can you close the position? You can. You can buy to open at $2, and then the stock price went up, then you sell to close. So you make what? You make $1,350. Do you have to exercise the call option to actually make this profit? No. You just sell to close. So what if it doesn't work? Okay, what if it doesn't work? The stock price goes down to $95, and then
you bought the options at $2, then after that you realize that the premium is only trading at 4 cents. What you can do, you just want to cut loss, still got a little bit of money, then you sell to close. And then how much you lost? $160. Can you put a stop loss on it on this kind of the options? Yes, you can also. You can. Okay, this is how it works. The premium changes. Nothing to do with the obligation of those things. But if let's say the buyer early exercise, then it's very bad luck for you lah. Like for the seller. Okay. So buy to open, then you just the obligation. Forget about what I said. Like the obligation things. That one is from here. Basically, this one just sell to close. Okay. So let's look at the long put side. Long put. We focus on buyer first. Focus on buyers first. If we are buy to open the put options with long put, are we bullish or bearish? We are buying the put option now. Are we bullish or bearish? Can someone answer me? Bearish. So we are expecting the price to goes down because we know that in general, if the underlying price goes down, the premium price goes up. Okay, and you are a buyer, you want to buy low, sell high. So you buy to open the position, the option position at $1.50. The stock price really lucky is like drops until $85. Then you can the put option increase in value. It increased until like say for example $16. How much profit you can make? Like 1,450. So you can sell to close this just to make this money without any exercise. Okay. So what if the stock rally to 105 and then the premium will be goes down because like the stock goes up, the premium the put options will goes down, and then the premium maybe during that time is like only 20 cents, then you can sell to close, then that's the net loss. Okay, that's the net loss. So in short perspective, okay, initially you sell to open. You sell to open at $2. So what you do, what will happen? Okay, what will happen? You collected $200 here. If you are shorting a call, you are betting on what direction? Bullish or bearish or neutral? You are betting on what? Bullish, bearish, or neutral? Bearish, okay, bearish, okay. Very good, very good. You guys already know. Like, because I don't want to. If I shorten the call, I'm bearish because I don't want the stock price went above the $100. Okay, I just want to collect the premium. Okay, I just want to collect the premium. So I sell to open, I collected $200, and then the stock price went at the expiration, or maybe like before the expiration, like 2 days or 3 days, it falls down. It falls to like $98, and then your premium during that time is 30 cents. Remember, like because like if the stock price goes down, your call options will be going down. So during that times, your premium is trading at 30 cents. You short at $2, so you buy back at 30 cents. You're making profit, right? So you use you collected $200 so that, and then you buy back at $30. You're paying $30 to actually close this position. You are making what? 170 profit. Okay. For those who don't know about short trading, shorting, how shorting can be profit. This is how it works. Okay. But what if it went down to like 99.5? Still also can, right? Because if let's say it went sideways still below $100, so the premium usually will be just depreciate, and then until a certain level, then you can buy to close. Okay, so basically the correct answer is actually bearish and neutral. What is the losing part? What if the stock like went up, it spiked up and 110? You collected the $200 premium. Now the option, because the underlying goes up, then the call option premium goes up, right? Then your premium is trading at $11. you have to use a higher price to buy back to close your position. In this case, you collected $200, you have to pay 1,000 and 1,100, a thousand, sorry, 1,100. So your net loss will be 900. Okay, your net loss will be 900. So if we are shorting the put, so the last one, if we are shorting the put, what's that? What direction? What direction we are betting on? Come on. Are we bullish, bearish, or neutral? Bullish. Yes, bullish. Because we don't want the price falls below the $100. If not, then we obligated to buy, right? If let's say our intention is just want to buy, want to collect the premium, we don't want to buy the underlying, then we are expecting the price to be what? To be bullish, because we don't want to don't want the price to fall below $100. If not, it will getting in the money, then the put option buyer might be exercised. So we say, in this example, we sell to open $1.50. So we collected 150. Then the stock rally to like $2, and then because the stock price will go up, the premium of the put options price will be going down. So I buy to close the option at $50 only. So that I make a profit of $135. What is the losing scenario? If let's say the stock price crash, because stock price goes down, the put options price will be going up. Say for example, it went up to like $20. I need to use a higher prices to actually buy to close. So in this case, I paid 2,000, so minus my costs, but the premium that I collected, then 1850. Okay, clear? We are clear. So here's the second one. Like same, we will be having a knowledge check. The first 5 correct answer get the 2,000 Moomoo points. Okay, so it will be there will be 2 questions as well. So make sure you guys be the fastest who answer it. Remember, within 21 days we will be deliver the Moomoo points into your accounts. Okay, because our back end needs to check. Are you guys ready? If you guys ready, then type 1. Okay. If you guys ready, then type 1. Let me know you guys ready. Okay. All right, we are ready. So 5, 4, 3, 2, 1. Okay, come on. If you believe a stock is going to rally, you want to buy a call now and sell it later for a higher price, what is the correct sequence? This is the first question. You want to generate income by selling a put. You plan to cancel your obligation by buying it back cheaper after the time pass. Okay, what is the sequence? Okay, come on. You must answer 2 questions. Okay. Okay, we have lots of answer coming in. So let's uncover the answer. So the answer is B and A, because like if you believe if you're buying a call, which means what? Buy to open, and then you want to sell it later at a higher price, sell to close. So the answer is B. So, and then the second one is that you want to generate income by selling a put, which means what? You're opening a position by selling it. So it's sell to open. Then you plan to cancel your obligation because you don't want the obligation. You just want to buy back at the cheaper prices. So you buy to close. The answer is BA. So congratulations for those who answer the questions correctly, so that our backend will be do the computations within 31 days. You guys will be receiving the Moomoo points. All right. Okay. So let's look at the final parts. Okay. Because of we understand there's a four different kind of the different kind of the role for the country, and then 4 different kind of the way to approach the option market, right? but we need to understand what is the P&L diagram it looks like. Sometimes you look at those sort of options, right? They will show you this kind of graph, right? They'll show you this kind of graph. Remember, I also showed you during the chapter once. So this how do you actually see this graph? So if you're bullish, if you're bullish, basically you long call, right? You long call, right? Okay. Say for example, if your premium, if the bid ask is like 490 and the ask price is 510, the mid price will be $5. So if say for example, you enter into the position, then you feel at my mid price $5, which means that you are paying $500. By the expirations, how much you can lose? Maximum loss is only $500. So that in this case, when the underlying is here, and then you're buying the options, call option at this point of time. So no matter how far it goes, it drops, the maximum loss will be only $500. Okay, but if let's say for call options, right? For call options, it has to go what at the this is for at the expiration. It has to go beyond where? Beyond 105. Why? Because like my strike price is $100. Sorry, I forgot to mention this one is considered your strike price is $100. My strike price is $100. I add my cost. So at the expiration, I have to go beyond 105. I only can make money. Okay, this is from at the expiration. At the expiration P&L, which means that if let's say after expired already, then the price have to land as if you are exercise and buying the underlyings, it has to land above 105. You only can make profit. Okay, but if you are shorting a course, right? If you are shorting a call at this point of time, the maximum profit you can keep is what? The premium that you receive, right? So in this case, if let's say you sell to open and then it got filled at $5, which means that you are collecting $500. If let's say the price is like remain below 105, you still profit. But if let's say the price goes up, keep on going up, your max loss can be unlimited because it can land at like it can go up to $100, $120, $130, $140, $150. So your max loss can be unlimited. Okay, got it? So in this case, remember, for buyer you have a limited risk but unlimited profit. While you are shorting a call, you are having a maximum profit and unlimited risk. Okay, this is what it means. Okay, so let's look at the put side. The same bid ask, like if let's say we are bought the put option $500, this is the maximum we can lose. If let's say the price, no matter how far the price goes up, that's the maximum loss you can lose. And then if let's say it goes down, it has to go below how much? $95. Okay, because 100 minus $5, then is the 95 break even. Okay, this is the long put P&L graph. But if let's say you are shorting a put, you are expecting bullish, right? So that the moment you sell to open, and then the maximum profit, no matter how high the prices go, the maximum profit you can get is just $500, which is the premium that you receive at the beginnings. But if let's say it goes down tremendously, okay, the maximum loss can be like can be quite a lot. Because why this one got number while the short call is unlimited? Because the underlying the maximum underlying can go to zero only from $100 and then goes down to like to zero is a $100 loss, right? Because you collected a premium and you minus out the 500, then you get the maximum loss is 9,500. So that you can see why some people want to do still want to do some shorting, because it looks very dangerous, right? Actually, it's like some people do spread. Okay, they in the future I will teach you guys how to actually do spread. But before that, we will teach you do some like underlying spread first, like cover call and all those kind of protective wood, those kind of things first, so that you understand better. So, and then some of the people's like they don't care why they don't want to do a short put. Like Warren Buffett, he loves to do short put because, say for example, if let's say the stock price is now at $110, and then I sell a put options, like I call it a premium, then at $100 strike price. If the stock price goes down below $100, then the Warren Buffett is very happy because he can obligated to buy the underlying price at the strike price. Really, initially he want to buy $100 just because the stock price suddenly ding dong there and then didn't hit his target prices, the ideal price that he want to buy at. So he sell a put. He just want to buy $100 so that he choose the $100 strike price while the current stock price is 110. In the future, if let's say it drops below the $100, he's very happy because he can buy the stock at $100 and then hold the stock under for the long term. But if let's say the stock price doesn't come down, then he collect the premium. Then he just collect the premium. So this is those kind of a case where you actually is like depends on your intention. If let's say you want the underlying, then the shorting the place is a very good strategy. If you have the buying power to actually want to buy the underlying and hold for a long term lah. And then you want to collect the premium as well. Okay. So, and then the probability as well, because like no matter, you can range between here. If let's say it went sideways, it goes up a little bit, it didn't go a lot, it drops a little bit, you still can profit. You still can profit. Okay. But make sure here, because you see the slope here, it means that if let's say after expiration, is considered in the money, and then you got a sign already, you bought at this pricing, okay, because you collected premium at the beginning, so it's still considered after minus your unrealized losses in the underlying, you still profit. This is how it works. You need to close the underlying position at this at any kind of the level between here, you only can profit. Realize the profit diagram that here mentions. Okay. Remember, this is after expiration. You got the stock price already. You have to land somewhere here, and then you need to calculate the P&L. Okay. So how you actually like see those kind of P&L? Remember, I taught you guys already, right? So you just open up your apps and then you go to the option chain. Then you see whatever ticker symbol you want to buy. If you are long or put, then if you want a long, then you just press here and then you tap. Then there's a dialog pop up. Then you just click on the arrow here. You can see there's a P&L graph here. So you can see the long call is very similar. It's the same that I just showed you, right? Okay, it's the same. So that it just like basically it just be like the strike price plus the premium that you have paid. So this will be the break-even prices. So by the expiration, it has to go beyond here. But if let's say you just want to buy to open, sell to close, okay, that one because of the probability changes, right? Can you see the dotted line here? The dotted line, the dash line. That one will be the price where if today I buy this option, it rises to a certain level, then how much my P&L will be. Okay, this is basically just what I meant. And then if let's say you want to see the different kind of a graph, like for example, in this graph is very obvious, it's a long call. And then this one is what I sell, call. If you are selling a call, then you are expecting bearish and you should. And then if you're long a put, yeah, you're expecting bearish, then you only can profit. If you are expecting what? If you are expecting sideways and bullish, then you actually can do what? You actually can sell put, actually collect the premiums, do sideways and do sell put. And you see this kind of graph, and then you can see how much of my cost and break, those kind of things. Okay? Are we clear? Okay. So basically this is the end of our sections already. Okay. It's already end of the section. So basically you just need to understand like where is your P&Ls come from. Okay. You guys just wanna do a day trade and then you just want a long call, and then if it goes up by a certain level, how much profit I can make, you just look at the curve. You just tap on it and then move around. Then it will be, you can see the actual P&L. Okay. It's quite a lot today, right? It's kind of a lot. But no choice. You guys have to like understand like these kind of things, because if like, let's say you guys don't understand these kind of things, then it's very hard for you to do those kind of spread. Okay. Because in the next phase, because phase one now already end, you guys know, like phase one already end. These are the basics you just need to know. Phase two will be teaching you guys like how to actually generate income while holding your stock, those kind of things. And then I'll be teaching you guys like how to actually use these kind of things like short call with the stock to become a cover call, those kind of things. Okay. All right. It's kind of late now, so like yeah, you guys can watch the replay after. So yeah, it's getting late already. So and then it's almost 9:30 already. The market is going to like uh it's going to be trade opening soon. So yeah, I hope you guys enjoy the sections. Okay, I know it's a lot. I know it's a lot. I really do, because like when I was starting learning about the options, yeah, this is this is where I get confused. Okay, but yeah, this is how you actually need to understand. Okay, what is arm trade?
AI.
Okay.
Pre-market.
Oh, okay.
AI.
We don't have much time to do that, but maybe in another session, so maybe like Alvin section, those Alvin sections, yeah. In Alvin section, maybe another Alvin sections you can cover this. So my sessions is already done here. So like the IV is still low. Okay. IV low doesn't mean but yeah, that was another story lah. Okay. So yeah. So yeah, I hope you guys do enjoy the section. So I'm going to, like it's getting late. I hope you guys can actually like digest those kind of session, watch the replay, and then sometimes if the calculation is a bit mess, then you guys can further research like how it works actually. Nowadays, like you can base on my slide and then my scenario to actually use AI to actually teach you how it works. So it's getting more convenience now. So I hope you guys really can like master these things, especially from the foundation to this. Okay, foundation. If you don't understand like certain, you have to understand like strike price, what is call, what is put. Those are the basics. Like the exploration things, you can slowly adapt to it and then learn it. But strike price and the call and put is a very important thing, because it okay, and the premium things, the extrinsic value and intrinsic value, because like it dictates how you actually can pick up the right strike for your positioning. Okay, you guys can. So okay, I hope you guys do enjoy, and then yeah, happy hunting. All right. Okay, almost close open already. Happy hunting. Happy hunting. Thank you guys. Thank you. See you. All right. Thank you.